Hi, good afternoon, class. It's afternoon for me. I don't know. I'm sure you guys like to work the late hours of the night and the wee hours of the morning. I'm an early riser, and so that's just like my son. He likes to sleep in and stay up late. So I kind of live on a different time zones. Feels like sometimes than my son, and probably like you. So again, I'm recording these videos as a supplement to the Principles of Accounting course at UNT. You have availability of all the fantastic Pearson lectures, and you are required to look at those. But given that we have an exam coming up shortly on Chapter 6, Chapter 7, and Chapter 9, I thought I would supplement each of these chapters with my own look at it, and hopefully at least a high summary level. So there's going to be more. I will not be able to cover everything that will be included on the exam, but hit some of the high points. So again, I hope that you're safe. I hope that you're healthy. And of course, I hope you're reading the textbook. You are listening to the Pearson lectures, using the study plan. Even though this next exam is going to be open book, open notes, don't think it'll be easy, right? The worst exams I ever had were the open book and open notes exam. So yes, we have made this exam harder, given that it's open books and open notes. You are going to have to know the materials. You're going to have to study just like you would have had to do for an exam that was not open books and open notes. And there's a time limit. There's a lot of questions will require you to quantify amounts, and we'll look at some of those here for property, plant, and equipment today. But be ready, study hard, be prepared for that exam. Again, thank you for staying engaged. I know many of you are, and always available via email. You have my email address. I respond pretty quickly. Do not email me through Canvas or other means. Email me directly to my college email address, which is available in the syllabus. Again, we'll get started here, and I'm going to share my screen right now so you can see what we're going to talk about. Yeah, I got a lot of stuff there on my screen. All right, here we go. And I always like to start any of these subjects, whether I'm in class or not in class, with hey, what are we trying to do here? Because that really matters. And I'm going to turn off these lights because they're blinding me here. Get that out of the way. All right, here we go. Now, much better for me. So, keep in mind, accounting, I always say it's about measuring transactions, measuring the business, and it's also about reporting. How is the business doing? What's the financial status of the company? Keep in mind, in science, we use inches and feet, gallons. We use all kinds of things in science to measure different things. However, in accounting, guess what? As you know by now, we use debits and credits. Debits increase assets, and credits reduce assets. Credits increase liabilities and equity, and debits decrease liabilities and equity. Obviously, I know you guys already know that by now. And so when we come over here and look at the income statement, that owners have all the rights to the income of the business. So credits, revenues increase net income and therefore have a credit balance, and expenses have a debit balance. Again, just a quick refresher here. So in this class, we're going to look at long-term assets. And so there are some differences here. And to compare and contrast, let's think about the last chapter with inventory. Inventory was easy. We buy it and then we sell it. And so when we sell it, if we don't own it anymore, it moves into cost of goods sold, into an expense. So, what is an expense? Let's just pause there and think about what an expense is. An expense is using resources, right? And so we record expenses when we use resources, sometimes when we create a liability, like we use resource of our employees, and maybe we'll pay them their salary later in a subsequent accounting period, but we're using their hours, their competencies, their work for our business. And when we're using our employees to perform work, we're going to record an expense, in the amount that we owe them, but also timing matters for expenses. We're going to record that expense when they provide that service, not when we pay them. Same thing for inventory. We buy inventory, and then when we use that inventory to create a revenue, we sell something, then we create an expense. And we saw in the last chapter that expense is called cost of goods sold. So I think if you think about salaries and inventory, they're used almost right away. And so it's easy, we sell the inventory, we record an expense when we no longer own that inventory. Well, it gets a little more complicated with a long-term asset. And let's say we buy a building, maybe it's a factory, maybe it's a warehouse. And let's say, just for example here, it cost us $1 million. And so we're going to, credit cash for $1 million, and we're going to debit an asset, a long-term asset for $1 million. And now guess what? We're going to use that asset. Let's just assume for 10 years. Buildings a lot of times might last us 30 or 40 years. But let's just assume, to make the math easy, we're going to use that building for 10 years. So let's go through that first year of that building's life. Well, we've used a resource. We've used that building. And if we didn't have that building, we couldn't have kept our products. We couldn't have maybe manufactured our products if we were a manufacturing company. We couldn't have had revenues. So we're going to have to expense that building. But we only used 1 year of it, 1 year of the life of that building. So now, how do we expense the use of that building? Well, we're going to take little pieces of that building and expenses. And it's going to be an expense. We call that expense depreciation expense, meaning we're going to use 1/10 of that building in that first year. And so every year, we're going to expense a little piece of that building for 10 years. So that's very different than inventory or salaries expense or other things. These are long-term assets that we're using, and we're wearing them down as we use them, right? They do not have unlimited useful life, so therefore we're going to record depreciation expense. Remember, expenses, what kind of balance do they have? Debit balance, right? Because they're reducing equity, they're reducing net income. And so the expense we're going to record is depreciation expense. And let's just use, for this example, straight line, what we'll call straight line depreciation methodology. We're going to learn other methodologies, but let's just consider straight line. And so we're going to use 1/10 of that building. Let's use that building as an example. We'll record each year $100,000 depreciation expense because we're using up 1/10 of that building over its useful life of 10 years, right? So we need to credit an asset. Well, in accounting, we do not credit the building asset. We leave, so when we buy that building, let's just look at some T accounts here. You know how much I love T accounts. That building has a $1 million debit balance. And yes, we could just credit building every year until the building balance goes to zero. Well, we don't do that. We like to track how much we originally paid for the building and then how much the depreciation has built up over time. And so we're going to have a new account, and it's called accumulated depreciation. And we're going to record all the depreciation expense in this account. And so let's go do that up here. So this was a debit to depreciation expense. We're going to credit an asset account, and it's a new account for you. It's called accumulated depreciation. 100,000. So guess what? Let's look at the T account. And here's a surprise for you. This account is in the asset side, and it's an offset to the building account. What do we call this? We call this a contra asset. A contra asset always has a corresponding asset that it's related to. We looked at allowance for doubtful accounts back in an earlier chapter. That was an offset to receivables, and the allowance for doubtful accounts had a credit balance for uncollectible accounts. Same thing here, it's got a credit balance. By the way, that is where the name contra asset comes from. It's contradictory because it doesn't have a normal balance. If it debit, it's got a credit. Let's go to year two, just to make this easy, interesting. Year two, so this is year one. Year two, we're going to record another entry, depreciation expense. In year two, for 100,000. And we're going to record another, we're going to put some more credits in that accumulated depreciation account. And so year two, we put another 100,000 in there. And at the end of year two, we have a $200,000 balance in accumulated depreciation. And by the way, we'll keep doing that for 10 years until there's going to be $1 million in the building and $1 million credits in accumulated depreciation. And then we stop because now we've used up all of that $1 million we paid for the building. Theoretically, we've used up that building in its entire useful life and we're done. Now, one other concept I want to share with you, another term, if you will, is carrying value or net book value. And at any point in time, the carrying value, the net book value, is the balance in this account minus the accumulated depreciation. So we would say here that this building at the end of the second year has a net book value of 800,000. Makes sense, right? Because we paid $1 million for the building. We've used up 2 years of what we like to call useful life. And now the book value, the net book value or the carrying value is 800,000 at the end of year two. Guess what? End of year three, 700,000. End of year four, 600,000. Because we're going to keep putting 100,000 into that every year. Really straightforward, really easy, except we're going to do some funky things. That's what we do. There are 3 methods of, just like LIFO and FIFO in the last chapter. You know, why would we just make this stuff easy? Then it would be so simple, right? So we're going to have different methods of depreciation. We're going to have what you just saw. By the way, my handwriting has not gotten any better on the online class than it was in the regular class. I'll have to apologize for that. And another method is going to be called the double declining balance method. And we're just going to, let's just compare and contrast these. We're never going to record more depreciation than what we paid for the asset. So if we had a building for $1 million, we're going to depreciate $1 million, both on the straight line and the double declining balance. However, in a double declining balance, we will record more depreciation in the earlier years. And we'll look at an example of that. And then another one I will talk about is units of production. And we'll look at various units that we can measure of how much we're using that asset. You know, a vehicle would be a good one to look at this way. Let's say we buy a whole bunch of trucks for our service technicians in a particular business. We expect a truck to last 100,000 miles. And so we will just book an expense based on the miles that that truck was used during the year. And so we'll look at units production method as well. So with that, let's get into some examples here. And I've got some templates. By the way, all of this is online for you. And these templates in Excel spreadsheets are there for you online. And so you can print out these templates and you can work problems. In fact, I have a bunch of problems in that Excel spreadsheet. I'm going to work for them, 3 of them at least. So I can show you each method. Then I'm going to do 1/4 problem on the gain or loss on sale. So let's start here with the first one. We're going to buy a building that is sitting on land, and it's worth, it's going to cost us $500,000. So our first entry, by the way, is debit. Well, I'll have to show you that in a minute because we got one more step to do here. Because, and we covered this in class, I haven't talked about it in this video, but we do not depreciate land because land is considered a permanent asset. And we're not, however much we use land, it's still land and it's still going to be there 1,000 years from now, God willing. And it will still be there. So we never depreciate land. So land is never factored into expense. It just sits there on the books. But here we have a building that's sitting on land. So we got to figure out how much do we record as land. And so we'll use an appraiser and we'll get the separate fair market value of the land and the building. And for this example, let's assume the fair market value of the land was $180,000. We'll have the appraiser look at different land plots and determine if what would the fair market value be if there was no building on it. And then we'll go get the fair market value of the building. And in this example, I'm going to use $420,000 for the building. So if we had to build that building, it would have cost us separately $420,000. Now look, if you add those up, it's going to be worth $600,000. And so we kind of got a deal on this, buying the land and the building together. Now, one other thing we're going to need to know to calculate depreciation expense is the useful life. And so the useful life in this example is going to be 5 years. And then at the end of that useful life, we will hopefully be able to sell that land and building. And in this example, we're saying the residual value of the building is going to be $20,000. So we could sell that building for $20,000 at the end of the useful life. And so we're only going to depreciate the $500,000 we paid minus what we hope to get back at the end, $20,000. Now, step one. Step one exists in this problem because we've got a land and a building, and we've got to separate out this land and the building. So let's just go look. Separate fair market value of the land was $180,000, and the building was $420,000, or that equals $600,000 in total. I'm going to look at 180 divided by 600. That equals 30% of the fair market value, and 420 divided by 600,000, 70% of the fair market value. What was our total cost? $500,000. So now we're going to take 30% of 500,000 and we're going to allocate that to the land account, 150,000. We're going to take 70% of 500,000 and we're going to count the building for 350,000. Total 500,000. We cannot put 600,000 on our books. We didn't pay 600,000. We have to put on our books the amount we paid for. Remember the historical cost principle. So the first entry we're going to do here is debit land, 150,000, and debit the building account for 350,000. And we're going to credit, let's just assume we paid cash for this, 500,000. That's our first journal entry. Now, let's go look at calculating depreciation. This is going to be under the straight line method. This example is a straight line method. The cost of the building is 500,000. Oh, sorry. 350,000. Residual value is 20,000. And so what I call the depreciable cost, the real cost over these 5 years is going to be $330,000. So the cost of using that building every year has to be recorded in debit depreciation expense, credit accumulated depreciation. And we're using the straight line method, so that's pretty easy. So we just take 330,000 divided by 5. So the annual expense will be 66,000. So 1231.17, depreciable cost is 330,000. If we want to use depreciation rate, we could say 1 divided by 5 equals 20%. So 20% of 330,000, $66,000. So first year, we're going to debit depreciation expense for 66,000. We're going to credit accumulated depreciation. And so what is our, let's got an error here. Sorry about that. Let's focus on the building account here. So what's our net book value at the end of the first year? The cost of the building was $350, still sitting in the building account. That we just leave there, debit building, and you never touch it. You're only going to credit accumulated depreciation. So what's the net book value at the end of year 1 or carrying value? 350 minus 66, 284,000. By the way, pretty easy example because every year we're just going to book the same depreciation expense under the straight line method. So 66, we're going to now have 132,000 in accumulated depreciation, and 350 minus 132, now we've got 218,000 here in the net book value. Again, year 3, 66,000. Now I've got 198,000 and 152,000. Year 4, 66,000, 66,000 debit, credit this account. So now I'm going to have 198 plus 66. I'm going to have 264,000. And my net book value, 350 minus 264, 86,000. And in the last year, 66,000, debit to expense, credit accumulated depreciation, so 66 plus 264, guess what? Voila, 330,000. 350 minus 330, $20,000. Guess what? That's the residual value. So we end up in accounting right where we anticipated to end up. All right. There you go. See, this is easy stuff. Again, keep in mind what we're trying to do here. We're trying to measure activities, which is the use of the building each year for 5 years, and record an expense for that will offset revenues and give users of the financial statement better information about how is the company performing. If we did not book that expense, we would be using that building for free. We don't use it for free. We have to pay for our buildings. But the difference here than inventory or salaries is we expense them over their useful life. All right. Now, I'm going to do a different example here. These are going to be a little bit funky here because I'm going to do a units of a production method. Let's just assume it's a vehicle. And a big monster truck, because I've got a big value on this one, $525,000. Let's assume, well, let's do this because it'll be more realistic. Let's assume it's a piece of factory equipment. I worked in businesses with super large factory equipment, sometimes costs millions of dollars, several $1 million. But, I guess you could get maybe a stamping machine for $525,000. And then every time it does a stamp or hours it's being used, we measure that. These machines, they're expensive machines, and factories like information to help them determine the real cost of their products. You get into that in accounting 2020. It's to me kind of fun stuff again. But let's assume that the machine hours are anticipated to be 100,000 hours. And we still have residual value of equipment of, let's call in this case, 25,000. We don't need to worry about the land in the building. It's not a land in the building example. I like easy to use this temple. So if we look at this, we're going to use a building that costs us 525 up front minus 25,000. So our total cost over the life of this building is going to be 500,000. That's the economic cost of using that building. And we're going to use it for 100,000 hours. Therefore, my cost is $5. Every time I run that machine for an hour, it's costing the business $5 for each hour. Again, don't need this example here. Cost of equipment. And let's just do this. Hours used. And so the original cost was 525,000. Depreciable cost 500,000. And in year one, let's just say we use this for 25,000 hours. So what's my annual expense? 25,000 times $5 per hour, 125,000. So I'm going to debit depreciation expense for put this over here in the right column. Debit depreciation expense for 125,000. And the same thing, I still credit accumulated depreciation for 125,000. What's my net book value? Cost of that equipment minus 125, 400,000 net book value. Year two, I'm going to use that building for 30,000 hours. 30,000 times $5 an hour, $150,000 annual expense, and debit expense for 150, credit accumulated depreciation. So now I have 125 plus 150. I've got $275,000 in my accumulated depreciation account. Hey, what's net book value? 525 at the end of year two, 525 minus 275. Well, now I'm down to 175,000. Do I have that right? 375, 450, yeah. 525 minus 275. Make sure that I got that right. Pull out the old trusty calculator. I don't want to have an error and then have to redo this entire presentation. 525 minus 275, 250. Yeah, I knew that looked funny. I'm glad I checked that. $250,000. Might have been a year ahead of myself. Year three, we only use it for 15,000. 15,000 times $5 in the per hour. We use it for 15,000 hours. And so that's going to be a expense of only 75,000. We didn't use it as much. And so therefore, look, the expense is less. We use for at half the number of hours. And so in one sense, this is a lot better example for a lot better reflection of the use of that piece of equipment. So now I've got 275 plus 75,000. Now I've got $350,000 in accumulated depreciation. 525 minus 350, $175,000 net book value. Net book value, cost minus what's sitting in the contra asset account, accumulated depreciation, equals net book value. In the fourth year, so we use it for 23,000 hours times $5 an hour, $115,000 expense, debit expense, credit accumulated depreciation, and now I've got a $465,000 in that account. 525 minus 465, 60,000. And in the last year, we use it for 7,000 hours times $5, $35,000 debit expense, credit accumulated depreciation, 500,000, and my net book value at the end is 25,000. Hey, guess what? Same as my residual value. So it's kind of a little puzzle there for you, if you will. And so, and again, very different than straight line, but it reflects the actual usage. And so this is a very, very good method. All right, third method, and definitely the most complicated one. Kind of like LIFO. If you like complexity, you should consider taxes as a career, because tax people love this one because it creates greater expense in the earlier years. Greater expense means higher tax deduction, pay less taxes. And so you'll see double declining balance used more in the for taxes than for financial reporting. Now, we call this an accelerated depreciation method, because you don't depreciate any more in total over the life of the asset, but you accelerate and depreciate more of it early. And so let's look at example. And got $150,000 land and building, $60,000 fair market value for the land, $120,000 for the building, useful life 5 years, and a $5,000 residual value. I'm not going to spend a lot of time on this. This would have been 33% and 66.6%, if you will. Total cost was $150,000. So we're going to put 1/3 of that, and that's 60 divided by 180, and then later 120 divided by 180 into the land account. You've already seen this in my previous example, and 100,000 in the building account. What we care about is the building account. So we got a $100,000 building minus $5,000 residual value. So we're going to depreciate $95,000. Now, one thing to note here about the double declining method, it is the only method. I think there might be a multiple choice question on that. It is the only method where we ignore the residual value in the first year. We're just going to deal with the 100,000. And guess what? Double declining rate. Double declining rate. What does that mean? We're going to multiply whatever the normal rate is by 2. So the 5-year rate is 1 divided by 5, right? 1 divided by 5 equals 20%. Double that rate times 2 equals 40%. So we're going to take the carrying value every year, whatever the carrying value is, and we're going to record depreciation expense for 40% of it. Cost of the building, $100,000. Depreciable cost is going to be $95,000. But in this case, we're going to look at depreciation rate of 40%. So we're going to take 40%, not of the $95,000. This is the one depreciation method. We ignore the residual value in the first year. We'll take care of it in the last year. We'll see that. So I'm going to take 40% times the cost, and my expense is going to be $40,000. How much is my accumulated depreciation after the first year? $40,000. That's the only thing I have in there. Now, we are going to care about this net book value to record depreciation expense. So my carrying value is $100,000 minus $40,000, $60,000. Why do I care? Because I'm not going to continue to multiply the cost of the building times 40%. I'm going to do the net book value. So 60,000 at the end of year 1 times 40%. So for year 2, 40% of 60,000, I'm going to record $24,000 of expense. Debit expense for $24,000, credit accumulated depreciation. Now I have 64,000 sitting in my contra asset account. What's my net book value? 100,000 minus 64,000, 36,000. Year three, 40% times what? Times my carrying value at the beginning of the year. 40% times 36,000 is going to be 14,400. Debit expense for 14,400, credit accumulated depreciation. So now I have 78,400 in there, 64,000 plus 14,400, 78,400. What's my net book value? 100,000 minus 78,400, 21,600. Year four, same thing. This is hopefully it's becoming making sense to you. 40% times 21,600 equals 8,640. How much do I have in my accumulated depreciation account? 78,400 plus 86,40, 87,040. What's in my net book value? 12,960. I'm going to pause here because the last year we don't use, and the very last year, whether it's 10 years, 20 years, doesn't matter. In the very last year, we're just going to plug the last year's depreciation expense to get to the residual value. The residual value is supposed to be 5,000. My accumulated depreciation, therefore, be 100 minus 5,000 needs to be 95,000. So this expense in the last year is whatever it takes to get to 95,000. It's the 1 year we don't use the 40%. Whatever is that plug number. So 95,000. Well, it'd be this. You can look at it this way: 12,960 minus 5,000. What do I need in there as a plug? 7,960. So in the very last year, and I know there will be multiple choice on this, 79 debit depreciation expense for 7,960, credit accumulated depreciation for 7,960, end up with 95,000, end up with a net book value of 100,000 minus 95,000, 5,000. So in both methods, we get to exactly the same place. By the way, if we'd have been using straight line, if we took 95,000 divided by straight line would have been 95,000 divided by 5 equals 19,000 a year. So look at this. We'd had 19,000, double declining had 40,000. We'd had 19,000, double declining has 24,000. But in year three, we still have 19,000, double declining only has 14,400. In year four, we've got 19,000 under straight line and only 8640. So this is why we call this an accelerated method. We book more in the very first year and second year, but over time, we still record the same total, same total amount. All right, we're almost done here with the lecture. One last problem. I just want to make sure you understand this. There are multiple choice on this problem, and hopefully the Pearson lectures are covering this good. If not, I'm going to tell you, it's going to be an exam. Get into the textbook. You cannot, just rely on my lecture for sure, or the Pearson lectures. You're going to have to get into the textbook, guys. That's the way it is. And so this is going to be at the end of the third year, we're going to sell the property. And so let's go do, let's purchase a building. For 110,000. Residual value, 10,000. So the depreciable cost is 110 minus 10. We're going to depreciate 100,000 over the term. Useful life, 5 years. And then we're going to sell the building after year three for 150,000. You can look right up the bat. That's a pretty good deal. We bought the building for 110. We're going to sell it for 150. So we're going to make money here. There's going to be a gain. But how much of a gain? Because we're going to have to go through here and depreciate this. So cost of building is going to stay the same all the way throughout, 100,000. But what's going to happen to my accumulated depreciation over those 3 years? Let's kind of do it like a little T account here for depreciation. How much is the depreciation going to be? It's 100,000 divided by 5 years. So it's going to be $20,000 a year. So year one, we're looking for year three. Year two, another 20,000. Year three, another 20,000. So at the end of the year three, we've got $60,000 sitting in our accumulated depreciation, and we've got a $100,000 debit sitting in our cost of building. What's the net book value? 100,000 minus 60,000 equals 40,000. Okay, guys, you could be business people here. What's 150? We're going to get cash of 150,000. We only have on our books $40,000 net as an asset. So 150,000 minus 40,000 equals a gain here on that property. So we're going to book a gain. But how are we going to do this? First of all, here would be the entry. Debit cash. How much cash did we receive? 150,000. And you can do it this way, just using a journal entry method if you want. We got to get rid of the building. Do we own that building anymore? No. So I'm going to credit the building account for, I'm sorry, that cost of that building was 110. So that was a bad math there. That building account had 110 in it. So I got to get rid of 110,000. Excuse my error here, right? Look at that. Oh my God. I hope you guys aren't doing your spot evaluations right now. So the net book value is 110 minus 60,000 was 50,000. And I had a $100,000 gain. So apologize for that error. I just picked up the depreciable cost. I should have picked up the purchase of the building. All right. Hopefully that will help you guys. So I have 110,000 as a debit sitting in my building account, but I don't own it anymore. I sold it. So I got to credit the building account. Guess what? I can't let that 60,000 accumulated depreciation just sit out there because that building is gone. I got to get rid of that balance. So I'm going to debit accumulated depreciation for how much? 60,000. See, 60,000 debit. Now I've got zero in there. Credit the building. I got zero in there. So I'm clearing those accounts out, if you will. So I've got $210,000 of debits, only a $110,000 credit. So I'm looking for a credit of 100,000. Guess what? Gains are credit. So gain on sale. If I needed a debit, that would have been a loss. But I think you could come back to check your work, look at the net book value versus how much cash we receive. We call cash proceeds. So proceeds minus net book value equal gain or loss. If we've received less than the net book value, that's going to be a minus. It's going to be a loss. If we receive more than the net book value, then that's going to be a gain. So in this case, we received 150,000. We only had $50,000 as the net book value, 110 minus 60, $100,000 gain. But again, for the exam, you have to also know how to do this entry. Again, I hope this lecture helps. Let's just stop the share here. Yeah, I hope this lecture helps. Again, any area of this lecture you're confused by, go look at the textbook, work problems. All of these are sitting in an Excel spreadsheet, and actually a couple more problems that is posted on Canvas. That's called, I believe it's called Property, Plant, and Equipment. But look on Canvas under Module 3, and you will find a spreadsheet that has all the accounting we just did and a couple more examples. So what you could do, hey, print out the template, go work the problem, and then check your answer. So guys, good luck. Hope that you're staying healthy, and do not be defeated by this coronavirus. We are going to fight, and we're going to win. We're going to get this sucker done. We'll get through this semester and call this a great victory. Again, open book, open notes, chance to just do a great job on this exam. But don't walk in an exam without studying ahead, being prepared, because it's going to be time limited. Once you start it, you're going to have to finish it. You only get that one shot. Thank you, guys. I do notice with it's better to use a system in the mornings than the evenings. That's been jamming great in the morning, but I know a lot of you are having problems in the evening. So the exam will be open all day. Get in there, get it done early. Thank you, guys, for paying attention, and I just hope that you do great on this next exam.